We've got Amar Kaul, the MD and CEO, joining in on the show right now. Amar, hi, good morning. Good to have you on the show. And we were just logging in into your con call yesterday. You mentioned that lower margins in the industrial segment are because of the rise in commodity prices and increasing share in the railway business and strategic investment in consumer businesses as well. Your current industrial order book stands at about 3,200 odd crore rupees. Tell me, what's the outlook going forward on the execution of this order book, and more going into FY26 if high commodity prices will prevail or you think rise further?
Yeah, hi, thanks, Aisha. Thanks for having me here. And yes, you've done your homework already by joining the earnings call. Yes, so there has been a bit of stress on the industrial side. But having said that, as I elaborated yesterday in the earnings call as well, is that the go-to-market strategy and also the operational efficiency that we are working on, we are pretty positive about how things should turn out. Having said that, inflation, yes, commodity inflation will keep going up and down. Obviously, we cannot control that. But how we can control is by being disciplined on the top line margin expansion. How can we pass it on to the customer? So which means balancing your demand side and supply side is what we are honing our skills on. So that is point number one. Point number two is also our strategic investment to consumer business. As you know, we are pretty bullish about that. So we'll keep investing in next couple of quarters. You will see that happening. So that will be a bit of strain because, of course, whatever we are earning in that business, we'll keep plowing back that money into marketing and visibility piece of it. So that will continue to be there. So overall, if I talk about industrial business, I would say it will keep inching upwards because we are gaining on the market share. I think that's important.
While you're investing, you would be investing from the free cash flow which you would generate. Could you give me a sense of free cash flow? How do you see that operating in FY26?
So free cash flow, if you see, I think that's the positive side of what we are doing, I think, which is sufficient for the investments that we have laid out, which is a couple of things. One is the expansion of our capacities. This is what we see in the market for different businesses, especially in the power sector. Yes, we'll continue to invest to keep expanding. That's where we'll use this cash for. That's number one. And number two, anything on the inorganic side, if it comes across, because there's a very disciplined process that we follow, something that is around that. So we'll use that cash for it.
I'm going to give us some sense on the railway business because I believe that the order book stands at 400 in, I guess that in FY25 you have secured an order supply of 450 for Vande Bharat train sets. But while we talk to other players, there is been a bit of an execution challenge. Give us some sense that are you also facing one, and what's the visibility on getting more orders?
I think the couple of things that we have been working on. Number one, the Vande Bharat 10 train sets order that we have, it's about 400 plus crores. Right now, the team is busy executing that. So we don't see any challenges. Yes, of course, we have approximately 12 months to execute it. We have been very disciplined in investing into our R&D team. So technically, if you tell me in last 12 months, we have graduated almost 4 times the number of people that we had in our R&D. That is the key for developing these Vande Bharat train sets. So honestly, we don't see that challenge there at all because we were early on in the game. That's point number one. Point number two is also, you talked about margins from railways. Yes, we know we stay committed to Indian Railways for the nation building. But yes, there's a lot of impetus on the exports market as well. And I think I talked about it probably in the earnings call. We are one of the first companies which got certified by American Association for Railroads. And currently our motors are running in American Railways for testing. More than 3 months it's there, no issues. So hoping that comes in picture, I think we can look at a better future.
Railways is one of those businesses where competition intensity is highest and there is one buyer. I mean, there's only one buyer. And in any category, there are multiple vendors. Does it make sense for CG Power, where I've looked at your numbers in all avatars, earlier avatar and current avatar, it's a higher margin business, high return on equity, what you focus on. Why are you moving towards railways, which is a low margin and a high turnover business?
So very good question, Nikunj. So 2 things on that. If you see, we have been strategically expanding our expand our portfolio. Portfolio is, if you see, we acquired a couple of quarters back GGtronics as a joint venture majority shareholding in that, which is to gain on the technology of Kavach, which is train collision avoidance system. So that adds to it, which is currently under execution. And I'm not, I don't need to be shying away by saying we are one of the leading players in terms of technology and ahead of the curve, in terms of executing it, which is good for the nation. That's point number one. Point number two is railways. Yes, there's only one customer in India, but my prior answer that I said is we are not staying only with India. There's a big focus on exports as well. And we have made the investments into that area also. So we are setting up our own stuff with the customers overseas. Like I said, America is one of the markets where our motors are actually running in the American railways more than 3 months now. So the testing is over. Once the testing is over, the good news is that everything is going on fine. So that adds to it. So getting the top line as well as the bottom line, the strategy has been very clear to balance the two from the geographical expansion point of view and also from the product portfolio and technology point of view.
As we look into future, which are the new higher margin areas you would be, venturing into? Which is that new IP-driven business for CG Power?
So one is higher margin. See, you have to work on getting there, improvement. For example, nobody thought about the power sector. That's one of the segments that we have. The kind of margins you are getting there. It's also, one is the market, of course, is favorable, but second is also your operational efficiency. So continuously, lean has been our DNA, which we are working in to keep eliminating the waste in the system because customers don't pay for that. So the more efficient, operationally efficient we become, better it is for us to gain on the margin. Number one. Number two is also for future. If you see one is the core area of capital allocation, and second area of capital allocation is also in the strategic investment, which is our semiconductor business. So once that starts kicking up, you will see both top line and bottom line improvements happening there.
Okay, great to have you on the show then, Mr. Kaul. Thanks as always for highlighting how your earnings was and of course what the visibility is going forward.
If you like this video, then like, share and subscribe to ET Now.